All right, welcome back, everyone. Thanks for sticking with us for a couple minutes. We want to give everybody a couple extra minutes to get logged in this afternoon. Obviously, knowing markets have been a little crazy, we want to give folks an extra couple minutes to watch the close and then join us here today. Welcome. My name is Austin Fitch from Horizon Investments. I run our consulting team here at Horizon, and I'm joined here today with our CIO, Scott Ladner. Really appreciate you taking the time to spend with us this afternoon amidst all the craziness. For those of you that have been with us in the past, normally these are quarterly market reviews and then outlooks for the upcoming quarter. Today, the look and feel is going to be somewhat similar, but there's definitely going to be a little bit of difference in the fact that the last, let's call it week or so from a market standpoint, has been, we'll just say, uncharacteristic and in some cases historic. And we will talk plenty about all of that this afternoon. For anybody that is new, I will say, please don't hesitate to ask questions. We've got the Q&A feature turned on. You can drop those in. We will hopefully hit those along the way. If we don't, we do have a few minutes dedicated at the end for Q&A that we will spend there at the end of this time together. Before we get started, I do want to give a quick shout out internally, our compliance team, our marketing team, and our investment management team, just to let everybody know, about a week ago, we had what we thought was our quarterly deck ready to go. We had about, what was it, Scott, 30 something slides. We were ready to roll. And then sure enough, April the 2nd happened. And I think today the deck that we're going to go with only has about 3 or 4 of those same slides. So over the last 3 or 4 business days at this point, this deck has been completely rebuilt to be much more timely and relevant. So for those of you that run into any of those folks, definitely a big kudos to them. And thank you for the flexibility. We want to make sure we're bringing you guys content that is timely and relevant because we know conversations that you're having with your clients need to be the same. So that being said, we will dip into the agenda here. We're going to really cover kind of 3 main topics, right? We're going to hit on short-term challenges, obviously what we've seen over the last week or so, and what that means maybe for the short term from here going forward. We're going to talk about some of the long-term tailwinds. We've talked a lot about that over the last year and a half when it comes to maybe the strength of the U.S. consumer, the productivity boost that we're seeing from AI. There's a lot of different things that from a tailwind perspective, we came into this last week or so feeling. So we're going to talk a little bit about that. And then we're going to talk about markets and the effects, right? The benefits or potential benefits of diversification, all those things we want to make sure we hit on today. And we're going to try and do it in under 45 minutes. So with that being said, Scott, we'll turn it to you and let you kick us off kind of that first slide on short-term uncertainty. And obviously, we're going to talk about tariffs. Let's do it from the jump.
Yeah. Do you think we're going to talk about tariffs today? Yeah, we're going to talk about tariffs today. Look, this has been a sea change. What we saw out of April 2nd, the Trump announcements, the way he's approaching this, why he's approaching it this way, the implications for growth, not only in the U.S. and around the world, and also the implications for equity markets and bond markets and all markets. This is a big deal. So and frankly, it's it's a big deal in like not a great way, unfortunately. So we'll talk through kind of how I'm thinking about it, how we're thinking about it, and why, and then some of the things that could change that outlook as well. Which look, this was a man-made thing on the way in. It could be a man-made thing on the way out. But to start with, let's just acknowledge the obvious. The obvious is it's on the screen. We're kind of going off the charts here in terms of the kind of the level of tariffs that the U.S. is imposing across the rest of the world. And so these are sort of estimates right now. We don't know exactly what this is going to look like because we don't know how all this stuff's going to end up flowing through. And we don't know what some of the deals are going to look like, some of the negotiations look like. This is sort of best guess. But best guess is like, well, over the best, highest levels in over 100 years. But that's not unfortunately, that's not the most important part of the story. Like the next slide is, these are far more impactful than even Smoot-Hawley. And the reason why it's far more impactful is because the world is much more interconnected in 2025 than it was in 1930. And so the level of tariffs today, like for the same level of tariffs today as opposed to 100 years ago, they matter a lot more. Does anybody remember what supply chains did in COVID? when you screw up, when you screw up global, screw up global supply chains, you end up having not great economic outcomes, not only for for one country but for all countries. And so COVID was a sort of natural disaster supply chain mess up. This is a an intentional supply chain mess up. So and it has some of the same sort of implications, unfortunately, for for growth and everything, as the COVID supply chain mess up did. And the reason is just this. I mean, it's a far more interconnected world today than it was 100 years ago. And so these high tariff rates, you're gonna see a lot of you're gonna see a lot of the first chart where it's high, super high. What does that really mean? Well, it means a lot more now than it did back then. And so these are really, really, really impactful macroeconomic choices that are being made right now. And it's we'll talk through some of that a little bit as we walk through this. But it's just know it's a bigger deal now than it was 100 years ago.
Awesome. Appreciate you setting the context for us, Scott. I think one thing that we wanted to spend a little bit of time on today was this idea that the reason for the tariffs, at least being talked about from an administration perspective, is that America as a whole has been either on the decline or kind of stagnating for a little while. I think this is a chart from the Federal Reserve here where you see inflation adjusted income for the median American family, as we kind of highlight on the slide there, literally the middle of the middle class. And I think what's interesting is this chart maybe tells us that it's not nearly as dire of a situation as maybe has been communicated. Is that fair to say? And if so, like what's the implication? What's the outcome of that?
Yeah, look, this is what Pax Americana looks like. We've been living in a in a regime where we've kind of set the rules for the world with respect to war, with respect to global trade, with respect to currencies, with respect to all sorts of stuff. And we've got the reserve currency of the world in the dollar. And that's bestowed upon us quite a lot of power. And it's led to kind of outcomes like this, where we essentially trade intangible goods, or like AKA services, for things that other countries produce. This is why we have a goods trade imbalance. We'll talk about that in a minute. But the ultimate outcome is everybody's living standards are higher. And this idea that we've gone through, we've been being pillaged by the rest of the world in terms of them taking advantage of us. Like this is not what this is. This is the average of the average. Like this the 50, like literally the middle of the middle class. This is their inflation adjusted median, or inflation adjusted income for the last 75 years. It's a good looking chart. So like U.S. is in pretty good shape. It has been in pretty good shape. Like and by the way, we'll make it through this too. Like it'll be okay. But this is like the narrative that America has been in decline or is in decline or anything like that is just poppycock. I mean, it doesn't make any sense at all. This is the only chart that you need to see in order to understand that.
Scott, if we look at kind of these tariffs, another thing we're hearing about them is they're reciprocal in nature. Maybe help us unpack maybe why that's not exactly the case, and really what the impact of that is. Like what does that mean? And I think you just mentioned it, a goods-based economy versus a service-based economy. Like what are the differences there? And then what does that mean from a tariff standpoint?
Yeah. I mean, like they're not reciprocal because they're not reciprocal. Because that's not what reciprocal means. Like reciprocal means I charge you what you charge me. And that's not what this is. This sure everybody's seen this little equation on the left that's like it's got 6 Greek letters and needs 0 Greek letters. It's just like your country's imports divided by the like they're whatever. It's the good trades imbalance for a country relative to how much they they export to us. And it looks really complicated. It's not. I mean, these tariff levels were set basically to try to eliminate the goods trade imbalance for every country in the world. And that's this theoretically is the tariff level that would make that happen, ignoring all of the things that we know about how people and firms actually respond to tariffs and to changes in the price structure for them. It's which is that the first 2 things on the denominator there over there, but it doesn't really matter. Look, these tariffs were set at a level that effectively grind towards a halt the gears of global trade and the gears of global capitalism, and that's just what they're set at. So like I don't really have anything else to say about that other than the fact that it's a goods based thing, and the U.S. doesn't produce a ton of goods because we have a very high cost structure. Like our people like to get paid well. If you live in this country, like you like to earn money, you like to get raises, and you like to have a living wage and have all the things that are associated with that. And so, if you only look at the goods trades balance, yeah, we have a goods deficit. Like we import more stuff than we export. The issue with that is we have a services-based economy. We've had a services-based economy, like in a growingly service-based economy, for generations, like not years, generations. And so, this is, like the top thing on the right here is like 3/4 of the economy is services based. We don't produce a ton of goods here because we produce them expensively, and people don't like to pay expensive prices for things. And so, like the idea that we can turn into Ray Zelinsky down here and like just make all the, American parts for American people, like, and have everybody and have all those prices be low where everybody can afford them and be happy about it. It just isn't grounded in reality. We're a services based economy. That actually makes us really strong, because services-based economies are, they're immune from sort of macroeconomic shocks, much more so than sort of cyclical economies or goods-based economies, because you don't have inventory cycles like you do in places like that, or like we did 100 years ago. And so, a services-based economy is actually much more safe for the country. It's better, but it does produce, it does mean that we have to import some things that we actually want to buy. And so we have goods trades deficits, and we've had them for a very long time. But that, the tariffs were set at a rate to try to eliminate that. That's what they were set at.
So Scott, another thing that we've talked about internally is, right, if there is this desire to bring back manufacturing to the U.S., I think what we've had conversations about is that would be very difficult, nearly impossible, as we kind of highlight here in the title of this slide, just based on the labor market. If you look at manufacturing jobs as a share of total employment. So that's what this chart is, right? You're looking at total number of manufacturing employees as a percentage of all kind of employees or total non-farm payrolls across the U.S. And folks, you can see it. You're less than 10% of the aggregate workforce at this point. Now, again, we highlight NAFTA, we highlight China joining the World Trade Organization. Those have been kind of called out as a point in time where it's the demise of the U.S. manufacturing kind of environment. And obviously we can see that has happened or has been happening long before either of those went into effect. I think what's interesting, Scott, is this idea that if we want to become a manufacturing hub again, it's going to have to be a pretty significant change to the labor force, right?
It will. And it happens over years and years and years. I mean, this has been happening in the United States. We've been moving away from manufacturing towards services since the end of World War II. And so, if we're going to get back to trying to be a manufacturing hub and be a manufacturing-based economy, increase manufacturing jobs, then this is something that's going to take years and years and years and years and years. So it's going to take a while to get there if that's what the goal is. I just wanted to point out, like, the reason why I put this chart in there is just to show, like, this has been going on for a long time, and it's not like NAFTA accelerated. It's not like they're trying to join the World Trade Organization accelerated. I mean, this is just sort of, it's what's been happening in a developed economy that is based on technology. Like, we're really good at technology. We're really good at productivity enhancing things. That's why our living standards are higher than anywhere else in the world and grow faster than anywhere else in the world. I mean, ask Europe if they would rather have an industrial based economy or a tech based economy for the last 25 years. Our living standards have grown far more. Our unemployment's been far less. Our wages have grown far faster. We've had a lower unemployment. We've had less cyclicality with respect to the economy. So it's, like, this is the trade-off. So if you want to go back to a manufacturing-based economy, like, we're going to go back to those more, kind of more lower value-added, slower growth, more cyclical types of things. That is the stated goal of the current policy. I'm not talking about politicians. I'm talking about the policy. The policy is to try to take us back to a lower value-added sort of economy. And it's, like, I'm just trying to explain to you folks, like, why is the market revolting? Market's revolting because it sees this as a low growth, like a turn towards the more low growth, more cyclical types of things, like with an added spice of tremendous amount of policy uncertainty, because nobody knows what's coming next. So that's not a great cocktail for equity markets. And so that's, this is I'm trying to just highlight, like, these are sort of the reasons, like, these are some of the reasons why the market is having a bit of a fit right now. It's like it doesn't like this policy mix nor the uncertainty associated with it.
Great point, Scott. And I think the next piece that we want to hit on, and maybe changing gears a little bit, is this idea of, okay, if we put tariffs in place, there's concern, right, that the inflation conversation that we had a couple of years ago now is going to pop back up. I think we would view that actually from the other perspective, that maybe over the short term, tariffs may be marginally inflationary, but in reality, they're more of a deflationary mechanism. Is that fair?
Yeah, it is. I mean, that's always been the case in recorded history. There's no reason why it's going to be different this time. Look, tariffs are taxes. Taxes are something that take money out of the private sector and give it to the government. What do you think tariffs do? And these are massive, massive, massive tariffs. This is a massive, massive, massive tax hike. And so, tariffs, like taxes are deflationary forces. They slow down nominal growth. And so like, yes, like year one, like the next 12 months or so, we probably get a little bit of inflationary pressures. This is what the market is agreeing to as well. So, this is a chart of, what happened, what basically how the market is thinking about the inflationary dynamics in the United States over the next 3 years. The line that's going up is what the market expects to happen to inflation this year, the rest of this year. The other two lines are 2026 and 2027. Has inflation going back down? It's because like we think this, the market is reading this right. Tariffs are short-term inflationary, like 12 months kind of thing, but they're medium and long-term deflationary because they are taxes, and taxes restrict nominal growth. That brings down long-term inflation forces. That's stuff's not rocket science, guys.
So Scott, if we look at that chart, if we have kind of the conversation about outlook and sentiment, I think it's super important to make sure we hit on this idea of, if you're looking at the sentiment conversation or expectation conversation, there's been a pretty wide divergence between the two kind of sides of the aisle, right? The partisan divide, I think we can make the case as it stands today from an economy standpoint, maybe hasn't been as stark. This right here is a perfect example. It's a 1-year inflation expectation survey from the University of Michigan. And again, you can see over time, right, that varies based on, political party, right? Typically, there's a percentage point or two difference. What we're seeing now following the election last November, it's a pretty stark difference. And that leads to maybe some I won't say confusion, but it definitely leads to some questions being raised as we get into other survey data like we see here around expectations for financial situations or pessimism around the economy. Scott, maybe take us from what we just saw in terms of that stark difference to what we're seeing on this slide, and then what should we take out of it?
Yeah, so look, we wanted to put that the first slide, the slide before in there because it makes interpretation of things like this really challenging. There didn't used to be this much of sort of a partisan divide about how folks thought about their own pocketbooks, and sort of like their outlook on the economy. Like, yeah, you get some differences, but like this is like, I mean, we're going like this right now. It's kind of nuts. And the other point of this is like, so one, you have to take sentiment data like this or like surveys based type sorts of things with some kind of a grain of salt. Like you can't interpret them today the same way you did 5 years ago, 10 years ago, so on and so forth. At the same, so you have to sort of water this down a little bit. At the same time, there is information in here, the information is that coming into this is pre-Liberation Day, by the way. This is before the tariffs got announced. The U.S. consumer was starting to get a little bit dowered, and it wasn't getting dowered because more people thought their situation was going to get better. Sort of an average number of people think their financial situation is going to get better over the next year. It really just spiked because people think, so there's some cohort of folks that really believe their financial situation is going to deteriorate. And you can see this goes back to 1992. This is a pretty long time series. It's a very unusual proposition for the U.S. Population. I mean, we tend to be really optimistic folks. Even the depth of the financial crisis, it was kind of hovering around zero. And so it's this is a little troubling that we're kind of coming into this period of weakness with this kind of, I would call it, sentiment overhang to the bad side for consumers. I mean, we've not seen it show up in sort of behavior data yet. We haven't seen it show up in retail sales or their mall traffic or things that would sort of lead you to believe that they're changing their actual spending patterns, which is really kind of where the rubber hits the road. But this is like you got to sort of have this back of your head. People are coming into this period a little bit dour on their own financial prospects as a starting place.
And Scott, we saw that same type of information from business owners, right? This is, again, CEO confidence index. We see that same type of thing, right? Coming into Liberation Day, you actually started to see that drop as well. You're seeing the same thing, right? If you look at kind of the Bank of America Merrill Lynch investor survey, right? They put this out on a regular basis, and this is the second largest change that month over month where those fund managers are saying that the global economy will weaken over the next 12 months, only behind COVID, the depths of COVID there in March of 2022 over the last 30 years. So, Scott, I think you're seeing from a number of different places that pessimism was starting to creep into the marketplace before Liberation Day. Throw the tariffs on top of that. That has obviously contributed to just the rise in volatility. Is that fair?
Yeah, rise in volatility, and that chart just sort of sums it all up. I mean, like we are at a very high level of economic policy uncertainty. And look, let's make no mistake. I mean, the root cause of the sell-off that we've had thus far has been because of economic policy uncertainty. And the thing that we know about about kind of crummy equity markets is that the thing you need to solve, the thing you need to see in order for the crummy equity market to turn into a great equity market again, which it will, it will, guys. This is a time thing. This is not a forever thing. But the thing you got to solve is you got to solve the root problem, and the root problem on this one is economic policy uncertainty. Like we got to get that one solved, or at least have a direct kind of a path or sort of visibility into sort of the direction that is we're on our way out of this very uncertain period. Like you need charts like this to at least start to turn around, and then we can find a durable bottom and really start to rip again.
So, Scott, I think what's interesting is you actually saw it from the Fed. When you start to look at their economic projections, you see that level of uncertainty creeping back up there too, right? Like the FOMC puts out basically bands of uncertainty around each of the kind of component parts that you see on this chart. We've aggregated them up into one kind of index-based uncertainty measure. And again, you've seen uncertainty spike back up just over the last month that we really hadn't seen move in that direction since we saw COVID happen, right? Where you were basically maxed out from an uncertainty standpoint there for the Fed, really from 2020 through, let's call it end of 2022, you had started to see certainty kind of creep back in. And then obviously the last month or so happens and uncertainty jumps back up. So I think that's something that we're paying really close attention to. If you talk about the uncertainty conversation, it's not just market participants. In this case, the Fed feels it as well. Scott, if we do kind of one last couple slides here, as we talk about kind of short-term impact, we talk about perception from within the U.S. investor. What are we seeing on this chart, and why is it important?
Yeah, it's just really kind of trying to hammer the point home. I mean, the bars, the green and purple bars are just the AAII investor surveys. We're all familiar with it. Bulls minus bears kind of thing. When it's down here where it is right now, that means that the individual investors are very bearish. And obviously individual investors turn very bearish right at the time that the line is another uncertainty index. Right at the time when certainty started to skyrocket is when everybody got bearish. Makes sense, feels right, because it is right. Again, in order to just I'll make the point again, in order to get this thing to turn, you got to solve the root cause. The root cause on this one is policy uncertainty. So we know what to look for, guys. We know what to look for. We can't force it, and it is undoable in a day. It's literally this was done. It's kind of in a day. It's undoable in a day. We know what to look for. We know what the prescription looks like. But we've got to get it, and we can't really force it. So that is sort of kind of the short-term playbook, at least for thinking about how to think about this market and kind of where the bottom is.
And Scott, just to be clear, when you say it's undoable in a day, not that it can't be done, it's that it can be undone in one day, right?
Yep, like either side of it, which makes this super fun.
All right. So if we're looking at that level of uncertainty, one area where we haven't seen uncertainty, and we'll put yet in parentheses, is labor markets. So Scott, maybe this kind of segues into some of the tailwinds that we're talking about. Labor markets, no matter how you look at it, you can see we've got a number of different measures there. Really haven't seen labor markets start to get nearly as nervous as the rest of the market. Again, we've got yet in parentheses that could possibly be coming based on a number of different variables at this point. But why is that important, Scott?
Yeah, I don't want to blow through this chart. I mean, we're not going to belabor it, not to be a pun, but it is the labor market holds the key for everything. It always kind of holds the key for everything, but especially when consumer spending is the thing that makes the U.S. economy hum. People spend money when they're employed. They spend their wages. And so, like if you've heard us talking for the last 2 or 3 years, like we've been highlighting in every sort of way imaginable the health of the U.S. consumer, and they still are healthy. We're going to talk about that in a second. But the reason why they remain healthy is because they got a job, and they're getting raises. And so, like the reason why we chose this particular set of data was because it's small business, and we know this. Small businesses employ the vast majority of folks in the United States. I mean, S&P 500 companies don't, like, they employ a lot of folks, but relative to the whole country, it's not a whole lot. So we really want to look at, like, what are small business owners thinking about their employment situation, and how they're thinking about hiring, firing, and raises and comp. And right now, you can see, like, right now is like still not budging. This definitely is still some of the sort of after effects of the COVID labor market, where it was almost impossible to hire anybody, and so we saw labor hoarding on the back end of the COVID labor market. We still think we're seeing some labor hoarding, that people just they're very reticent to fire folks. And so, because they had such a hard time hiring, last go around. So, I think there's still some stickiness here, but if you want the one economic, like I said, the market, the key market indicator is the uncertainty stuff. The key economic indicator, labor market. Every way you can dice up the labor market, that is how we're thinking about the health of the U.S. economy. And right now, still looks good. So this gives us, some optimism here.
Awesome, good stuff. All right, so we'll take that. We'll put a bow on kind of the short-term conversation. Now we'll transition into the long-term kind of tailwind conversation. And Scott, I do think we have to start with a chart that we've shown some variation of for some number of quarters now, and the data continues to be relatively positive. I would say maybe in a lot of cases exceedingly positive as we talk about the consumer health. We get a lot of questions about high consumer debt. We get a lot of questions about, like, what is the consumer being, is the consumer over levered? I think this type of data shows us that the consumer is actually in a really good place, all things considered, once you adjust for income, once you adjust for their asset base, right?
Yeah, I mean, like, this is just, again, you also said it, like we've showed variation of something like this for a while. It's still a big deal. It's still important. There's a reason why we harp on it. It's because it is such a big deal. And this is still a healthy U.S. consumer. They're just a little annoyed and uncertain right now.
So, Scott, if we take that and then we transition to the AI conversation, another thing that we've talked about for some time now. Again, we're talking about tailwinds, things that are additive to the economy. The AI piece, as we've said for a number of quarters at this point, really could be a game changer. Obviously, in the face of some of the uncertainty, it doesn't solve all of the problems that we have today, but we do think it still gives us a lot of opportunity from an economy, both in the U.S. and globally, as we look out into the next number of years, right?
Yeah, I mean, like, there's a reason also. I mean, you said good, like, I would modify that as, like, it absolutely will. It is. Like, this is still the biggest deal going in the global economy is AI. Just like the biggest thing going, and the most important driver in the mid 90s was PCs and the internet revolution, and what that did to productivity fundamentally, not only in the United States but around the world, and for every company in every sector. It was widespread. It's still a big deal. AI is happening even faster. The chart on the right is basically the adoption rate. You can see the little dot there is how quick AI is going. It's getting adopted like crazy, and it is going to be a really big deal. It is being completely overshadowed right now by what is going on with the tariff stuff. But after we get through all this garbage, it is still gonna be in the background. It's still gonna be there, and it's still gonna be a massive driver of productivity gains around the world. The U.S. we got to make sure that we win it. And that's sort of a separate conversation. But it's the technology itself is still a massive tailwind. It's just getting overshadowed right now.
So, Scott, we talk about it being a tailwind. Like, to what extent is it a tailwind? I think these two charts paint a great picture for what that could look like.
Yeah, I mean, when people talk about when talk about productivity, like, it's kind of this amorphous, switchy concept. Like, nobody really, like, people kind of know what it means, but they don't really know what it means. And so the economists really don't know how to measure it. It falls out of equations and whatnot. But it's like, ultimately it just, like, means making more with less, or making the same, or making more stuff with the same amount of labor, the same amount of inputs, same amount of hours, whatever it is. Whatever's your sort of input to your making stuff process, you make more of it with the same amount of putting stuff in. That's productivity gains, and we saw it in the 90s with what happened. Just look at output versus hours, and we're seeing the exact same thing with AI. This is why we know that we're right on this, and we know what the economic outcome was from the mid 90s. It was massive growth. There's really powerful, strong growth. We think after we get through all this stuff, we're going to end up at the same place with AI and the economy. But like as I said earlier, we got to get through this first.
So Scott, we've talked about the health of the consumer. We've talked about kind of AI revolution. The other piece that sits as a potential tailwind is deregulation, and that's something that this administration has talked about as something that absolutely could and likely would help the U.S. economy. And I think we show this slide really just to paint the picture of as you look at economies that have less regulation. So the x-axis on this chart from left to right is more regulation to less regulation. On the y-axis, you're looking at productivity gains, right? And as you can see, there is a positive correlation. The less regulation, the more productivity gains that you should expect. Obviously, kind of the $50,000 question at this point is, when do we expect that deregulation to occur? And Scott, I think one thing we've talked about is right now it seems like the current administration has moved forward with the trade policy conversation first, and will tackle deregulation and potentially taxes later in the 4 years. Is there anything that's changed around that timing wise? What's your thought there, and what are we seeing?
Yeah, no, not really. I mean, it's just the focus. I mean, there's only so many things you can do at once. And so like we could use some pro-growth policies. We could use some pro-growth policies right now. And so the quicker we can get them, the better. We are gonna. I mean, I think we're gonna look. We're off the charts on the tariff stuff. At some point, like after everything is said and done, we're probably gonna be off the charts on the tariff stuff. I think we're gonna be off the charts on this too. To the right side, and so like that, that will end up being a good thing. It's just like, come on, let's get on it, guys.
All right, so we've hit short-term kind of headwinds, we've hit long-term tailwinds. Now let's talk about kind of market impact, and I think let's start in an area where we really haven't seen this big of a diversion or divergence, I should say, in quite some time, and that's really the difference between what we're seeing in the U.S. and Europe. And if you actually look at this chart, the bar chart is Eurozone growth expectations. The line chart is U.S. growth expectations. You can actually see those going in very different directions for really the first time, and as far back as this chart goes, which is over 15 years. And again, typically they move in a similar direction, maybe just different magnitudes. I think what's super interesting right now is you have kind of this fiscal thrust being pushed forward from the Eurozone that you're not seeing, and actually to some extent you're seeing kind of the opposite here in the U.S. And I think that really leads to kind of this divergence in expectations. Scott, then couple that with the fact that you're seeing kind of a weaker dollar and those growth expectations. Maybe that gives us an opportunity to finally, and for the first time and probably as long as many of us can remember, international's outperforming. Is that fair to think about?
Look, that's the recipe, guys. The recipe for having international stocks outperform U.S. stocks is 1, get the dollar go down. That's happening right now. 2, have divergent growth expectations. That's happening right now. And so if this were to continue, we should expect international stocks to outpace U.S. stocks. Also, like you said, for the first time really since the mid 2000s. It has been a while. But that's that's the playbook. And so if that playbook ends up continuing to sort of play out, as if the dollar continues to go down and growth expectations sort of continue to go like that, we should expect kind of more on the left side of this chart than on the right side of this chart.
And Scott, you hinted at it, right? This hasn't happened in quite some time, and that comes from the fact that, right, you've had foreign investors putting money like crazy into the U.S. We actually finally started to see that reverse course in Q1 again, even before Liberation Day last week.
Yeah, and we should probably go to the chart on the right first. Look, there's a reason why U.S. markets have been outperforming. This is Eurozone, but you could put any sort of foreign index up there, it's going to look the same. Like U.S. earnings have just clobbered international earnings, and largely because we got a very robust and very productive tech sector. That just earn money hand over fist. So it's a big deal for kind of the thing that's been the primary driver of outperformance of U.S. stocks for the last 15 years, and has led to something the stuff on the left, which is like foreigners just buying U.S. assets. Not it is like this chart of stocks, but we obviously know they hold treasuries as well. They're buying U.S. stocks quite a bit. So that has helped sort of from just a kind of demand supply imbalance. That's obviously helped some of the story as well in terms of U.S. stocks outperforming. The question becomes if those earnings start to collapse back together, and U.S. and foreign investors start to peel out of U.S. stocks in favor of their home country stocks, kind of what does that look like in terms of relative performance of U.S. versus international equities? I think we know the answer to that.
Yep. No, that's a great point, Scott. All right, so let's change gears one last time and let's try to land this plane. I think we're getting a lot of questions around recession, right? And whether or not a recession is being priced in, whether or not we should start to expect a recession. You've talked about, hey, the uncertainty is going to exist until we start to get a little bit more policy uncertainty. I think what's interesting, though, is if you look at the Treasury market, even as we sit here today, it's not pricing in a recession as we head into the back half of this year into next year.
Yeah, and looked at properly, the Treasury market got the no recession 23-24 call it right as well. People misinterpret and don't understand how to look at Treasury markets and yields and forward rates and things like this. But this is the right way to look at sort of the Treasury market's expectation for recession. If the Treasury market was pricing a recession, what you see is two humps, or you see that the line going down kind of below that what we call R star. Basically, you have it go down too far and then have to come back up again, signaling essentially the Fed has to cut rates well below neutral to become accommodative to spur economic growth again and basically try to solve a recession, and then kind of get right back up after the recession is over and sort of get back to quote unquote normal again. What we see here is just like sort of a kind of a slow kind of steady decline down towards what the Fed considers to be sort of neutral rates, and that's this is not the shape of a forward curve for a recession being priced in the U.S. Treasury market, which continues, I think, to be a fairly big deal.
Scott, one question that has come in that I think makes sense to hit right now is, at what point does the Fed step in and start to act? Is that a recessionary environment? Is that the time when they step in and potentially throw, in this case, the administration a lifeline? Like what are we looking at, and is that a possibility?
Probably going to take the labor market cracking. So we're going to need to see unemployment stats. Things about employment get much worse than they are today, because right now inflation is still above the Fed's target, and so it's not like we're sitting here with a zero inflation environment or with inflation already back at target. It's close, but we're not there. And sort of speeches we've seen over the last few days made it very clear that the Fed still considers kind of both sides of their mandate in play, both the inflation side of the mandate and the labor side of the mandate. And so we think that you're going to need to see a pretty material crack in labor markets, or if a really bad equity market outcome, over the short term, that probably gets them off their heels as well. So and probably more so than the equity market is going to be the credit market. So if the credit market really cracks hard, or if the which has, as we can see here, or if the labor market cracks hard, that could get the Fed kind of off the schneid. But it's probably takes one of those two things happening.
Well, Scott, I was going to say you did a great job parlaying this into the next slide that we had. Right, we're looking at credit markets as we sit right now. Yes, credit markets have widened, spreads have widened over the last week and a half, but they're not currently, as we say, freaking out. Like, you can look at where it sits relative to COVID, right? At what point should we start to be concerned from a credit standpoint?
When we start to see spikes above 1,000 essentially in an index like this. So this, what we did here is I intentionally kind of pulled out. This is the junkiest of the junk in terms of credit. So I want to see where's the weakest links. So this is a picture of the weakest links in the rated credit market. I want to see because they tend to crack first. And so whenever I'm looking at sort of kind of high frequency, very, very, kind of high frequency stuff with respect to credit, this is where I go first. I want to see where the weak links are. Weak links are, they're not awesome. I mean, you can see where it is. I don't have to explain the chart to you. We're at the sort of the high end of normal. But we're not freaking out yet. The caveat to that is these things can change fairly quickly, as we all know. But as we sit here today, neither the Treasury market nor the credit market is pricing in sort of an imminent recession. We are pricing in slower growth. And anytime you price in slow growth, you raise the chance that you're going to end up sort of slipping into recession, just sort of by definition. But it's but right now, those markets are they're signaling some fear and some concern, but they're certainly not a freak out stage.
Oh, that's great color, and I think this last slide hopefully helps us kind of communicate a similar picture, in the sense that if you actually look at the Thursday, Friday of last week, right? Those were 2 consecutive days where the markets were down over 4.5% each day, depending on markets you're looking at. Probably one of the top 5, top 10 worst 2-day stretches that we had seen in markets. But what history would tell you is that on a go-forward basis, that doesn't necessarily mean that things are always going to be, kind of the worst of the worst. Obviously, we're not suggesting things are up and to the right from here, but we do see historically that following those types of market events, you oftentimes end up in the green as you get further and further out. So we'll talk a little bit about kind of why that's important from a, remaining invested and sticking to a financial plan. I think that's a very important piece that we'll talk about here in just a second as we wrap up. But I think that's a really interesting concept. And if you look at the data, it actually supports that idea that there's power to sticking with a financial plan because oftentimes those 2 days don't necessarily mean that things are only going to get worse from there. So, Scott, anything else you would add on this slide before we kind of get to the takeaways?
No, I think you kind of hit the main thing. Is like, look, not freaking out when it's not necessary to freak out. Having a plan, having strategies in place that you understand what's going to happen. Having some expectational certainty about how your portfolios are going to perform through some of this stuff is a big deal. Gets people on track, and that is a lot of the goals based is keeping people on track.
No, great point, Scott. So again, we'll put a takeaway slide up here. There are a couple Q&A questions that have come across that we'll make sure we hit. But the takeaways being, hey, policy uncertainty is key. That's what's driving market uncertainty right now. Policy uncertainty probably, as we start to get clarity there, that cleans up and helps us around market uncertainty. We talked about the tailwinds, AI productivity, strong consumer. Like the starting place matters. We've said that many times over. As we've entered this period of volatility, I should say, the fact that we are starting from a position of strength is absolutely a positive. And then finally, we talked about those divergent growth expectations. I think that's important to make sure we hit on as well. As we look at, hey, maybe there's opportunities from a diversification standpoint. So, Scott, a couple questions that have come across. You kind of hit it at it there at the end. Nervous investors. You talk about our goals-based philosophy. What does that mean from a risk mitigation standpoint? What does that mean? We call it risk assist in some of our, internal strategies here at Horizon. Like, what does that mean, and how should advisors think about using those types of strategies right now?
It gives you a plan, and it provides some certainty about like what's going to happen in terms of like what has to happen in markets or your portfolio for an action to take place. And as we've discussed, if anybody's heard me before on this, if I said it once, I said it a million times. The easy part about risk mitigation is getting out. But get out decisions pretty darn easy, guys. Like you can set a stop loss or whatever. The getting out part's easy. The getting back in part is the challenging part, and that's having a process for that, having some science behind it, having some sort of systematic approach for for governing the get back in decision, because it is uncomfortable and the cost for being high is the cost of being wrong is very high. You have to have some sort of system, some sort of, something to guide your decisions that is not your gut. Sometimes we see policy being prosecuted by somebody's gut. It's never a good idea. We want to see some of these decisions being made systematically with some process in place that can deliver that expectational certainty, which lowers the temperature for people. It lowers it because then they understand what's going on. Then they have some certainty around stuff. They get the process, and they're not just flying blind out there. When you're flying blind, you make dumb decisions. So part of this is just like, let's not make the dumb decisions. Let's have some sort of process associated with how we make both the get out and the get back in decisions. It's incredibly important.
Scott, a couple questions have come across around recession. The Atlanta Fed's GDP Now measure, right, has come out and said that it looks like GDP is going to be in the -2, -3 range for Q1. And there's been talk, right? This administration's maybe trying to push a recession to get it out of the way early, and then the back half of the, those 4 years, maybe they resurrect this economy. What's the thought from Horizon's perspective on whether we enter a recession? Is it too early to tell? What, probabilities, all of those conversations. What are our thoughts there?
Yeah, look, 6 months ago, the probability of recession, 3 months ago, the probability of recession was like asymptotically close to zero. It was basically like non-existent. It's never non-existent, but you know what I mean. We're in a good spot. Today, sitting here right now, it's unfortunately, it's probably about a coin flip. It's the growth, the negative growth impacts from this massive tax hike, and compounded with the uncertainty that's been injected into the business system and into the consumer sort of psyche, is damaging. It's literally impossible to tell how damaging it is yet. So we will see, but it is the point about starting from a place of strength is important. Like we're not starting like the financial crisis, we started from a place of weakness. The internet bubble, we started from like super over levered, really over our skis, kind of unsustainable sorts of behaviors and balance sheets, and from both consumers and corporations. Like none of those things are true today. Like everybody's in a pretty decent starting place. Everybody that wants jobs got a job. Like we're getting raises. Like all this stuff is working pretty well. But the amount of uncertainty that's been injected into the system voluntarily is damaging. And so we're going to have to there's a lot of the work we're doing right now trying to figure this out along with everybody else. But it is, we've moved from basically negligible recession probability to in our view probably at least a coin flip.
Awesome. Scott, really appreciate you taking the time with us today. Really appreciate everybody listening in. We are 2 minutes over that 45-minute promise that we made you, but really appreciate you sticking around. We'll say the replay will be made available as soon as it's ready. We will put that out on our website. And I would say this, please do not hesitate to reach out, whether that is a regional director, whether that is a portfolio strategist, whether that's, just calling our internal desk and asking questions. We'd be happy to have those conversations. And we really, at this point in some of this market volatility, feel like we would love to help you help your clients. Anything that we can do in that situation, that's what we're here for. So again, really appreciate y'all taking the time this afternoon. Look forward to the conversations that are to come. And as I said, don't hesitate to reach out. We'd love to have those conversations, even in the midst of all the volatility and craziness. Thanks so much. And we hope everybody has an awesome rest of their week.